Life insurance is probably the last thing that comes to mind when we think about growing our money. But high income earners often put millions of dollars into this product, especially when the market crashes. I've spent more than a decade in this industry, and I've worked with banks, corporations, and some very wealthy families, and I've been able to help them use life insurance to build and also protect their wealth. Let me explain. If you were to look at life insurance as a way just to grow your money, it's not that attractive. But if you look at it like a fixed income asset, it starts to look really good. When someone puts money into a life insurance policy, they're never trying to beat the market. What they're doing is creating stability. It's safe money. They'll often have money in other fixed assets like treasury bills, sometimes CDs, fixed annuities, or just cash that they want to keep liquid for opportunities. But the problem with all of those other types of assets I just mentioned is that you have to deal with taxes. Whereas with a life insurance policy, if my cash value is growing between 4 to 5% per year, that's tax-free as long as I follow IRS rules. I was recently in New York City and I met with some high income earners. I went to a venture capitalist firm. I got to go to JP Morgan's new headquarters and meet a manager there. I went to a investment division of Prudential. Everyone I met was very, very high net worth and really knew what they were doing with their money. For example, when I met with someone in Prudential's investment division, he looked at the illustration that we went over and he saw the internal rate of return right around 5% long term. And he said, okay, this makes sense. It's a no-brainer if the policy actually produces 5%. So here we've got a policy that is more than 10 years old. And if we look at 2026, we can see exactly how much the cash value is growing by. So let's start in 2025. His cash value was $1,083,000. He paid $0 in 2026, and his cash value grew to $1,143,000. If you were to calculate the net return just for that year, the annual yield, it'd be just over 5.61%. The prior year, it did about 5.5%, and we can see what it's done year over year. So him seeing some actual proof gave him a lot of peace of mind that this does work provided the policy is set up right. The thing that he did not know was that a policy can be designed for cash value instead of being designed for life insurance. So the key here is making sure that your life insurance policy is truly set up for cash value. Now, this can be complicated, but here's a way you can simplify things. Look for two things. The first year cash value should be somewhere between 80 and 90% of what you pay into the product, and the break-even point should fall somewhere between 3 and 5 years. I'll give you a quick example. So let's pretend that this is you. You're getting a whole life insurance policy and you want to fund $10,000 per year. The goal is beefing up that cash value so you have as much as possible so you can then use that cash value for opportunities. So in the first year, if you put $10,000 into your policy, if it's designed for cash value, you might see somewhere around $8,500. And then finally, by the fourth year, where your total payments are $40,000, your cash value is now $40K. This is what I call your break-even point. And then by the fifth year, you're cash positive, which is fantastic. So we can actually look at some illustrations here as well. And I'll go over an example of what not to do and then what to do. Because what that individual at Prudential was sold was a policy of what not to do if the goal is cash value. So first, we've got an illustration where we're funding $10,000 per year. And what do you notice? The first year cash value is almost zero, $335. You get nothing back of that $10K you paid in. If you go all the way down to the 10th year, the total dollar amount that you have paid into this policy now is $100,000. And look at your cash value. It's not even $100,000. It's about $95K. Well, you finally get your $100K back between the 11th and 12th year. This is a traditional life insurance policy that's also the most common type of whole life insurance product that's sold, where it's just basic life insurance. Now, what you'll find interesting is that if we look at the exact same product with the exact same company and the exact same out-of-pocket for you, you can make that cash value look so much better. Let's take a look. So here, you've got the same $10,000 going in, but instead of $300 in first year cash value, you're at $8,700. That's 87% of what you paid that's immediately available in cash value. When you look at your break-even point, it falls between 3 to 4 years. So you're getting your money back much faster. And if we look at the 10th year, you've got almost $120,000. So you've got more money up front and more money long term just by designing the policy in the right way. Now, the second reason a lot of high income earners use this strategy has nothing to do with the returns, but it has everything to do with the flexibility. Life insurance doesn't have to be a payment that you're locked into. It can be a system that you're in control of. However, with a life insurance policy, you can design it to be extremely flexible. So let me give you a quick example. Let's pretend that this is you and you're interested in a whole life insurance policy for cash value. You call up a life insurance agency and say, I want to save 10 grand per year. They'll probably just try to sell you a basic life insurance policy because that will generate the most commission and profit for them. So if you're set up with a policy that has a $10,000 premium, specifically the words base premium, you're going to get a bill for that every year, meaning you will be required to pay that. And the cash value won't look that good either. But if you know what to ask for, you can have a policy designed in a manner where you can fund 10K per year, but your premium is set as low as we can set it, which is typically 10% of whatever our total desired payment is. So if I want to be able to pay up to 10K per year, I would set my premium at $1,000, and then I would have the option to add another $9,000 toward what is called my PUA rider, which stands for paid up additions. I also like to call this a cash dumping. Now here's the beauty of this structure. The premium is what I get a bill for. So now, instead of getting a $10,000 bill, I get a $1,000 bill. The PUA rider is what builds cash value, but I can set it up where it's optional. With some life insurance companies, you can just log on to a mobile app or your online portal and dump money into PUA. You're not required to put the extra 9K in, but when you add extra money, you see it show up in cash value. It begins compounding. That is the key to accelerating the cash value growth of a life insurance policy. Now, a question that comes up a lot of times here is, well, don't I have to have millions of dollars for this to actually work? 10K would be great, but I only see examples of people putting in 6 or 7 figures per year. The answer is no. It can work with any amount of money as long as the policy is designed properly. So here's an example of someone putting away 10K per year, but we're also going to look at 100K and also $1 million per year. And just follow along with me and look at the first year cash value and the break-even point of each example. These are the exact same products, by the way. So example 1, you've got 10K per year going in. You've got a $1,000 premium and $9,000 PUA payment, meaning 10% toward the premium, 90% toward the PUA. Your first year cash value is $8,700 or 87%. Your break-even point falls between years 3 and 4. Let's look at $100,000 per year. Your premium is $10,000 or 10% of the 100K. Your PUA rider is $90,000, total out of pocket, $100,000. What's your first year cash value? $87,000 and change or 87%. When's your break-even point? Between years 3 and 4. How about $1 million per year? The premium is at 10%, $100,000. That would be the yearly requirement in this example. There's your PUA payment of $900K, total of $1 million. First year cash value, 87%. Break-even point falls between years 3 and 4. Exact same product with the exact same company, all designed in the same way. As long as the ratios are the same, you will see very similar results regardless of the dollar amount. How you can start this right now is when looking at a life insurance policy, I would ask yourself the question, how much can I put into this policy on a good year? And whatever that number is, the perfect world scenario number, take 10% of that, and that should be your minimum commitment, or very, very close to that. Now, with most financial tools, once you use the money, the growth stops. One of the big advantages with cash value life insurance is that the capital continues to compound even when you're accessing the money. Now, the idea of borrowing against a life insurance policy can be extremely confusing. And a big reason why is because when you look at life insurance illustrations with loans, they look like this, right? We're going to simplify this with the same illustrations, but on Excel. To the left, we've got our growth scenario. So here, we're funding $100,000 per year. You can tell that the policy is designed for high cash value, as the first year cash value is 92% of what he paid in, breaks even almost in year 3 when we look at this example. Now, by age 50, take note of his cash value. It's $1.3 million, and his life insurance benefit is about $2.3 million. I also want to highlight the age 57 cash value of about $1.95 million and the death benefit of almost exactly $3 million. Keep that in mind because next we're going to look at the loan illustration. So here we've got the exact same policy, but with a $500,000 loan. Whenever we borrow against a policy, if I am you, what I want to understand is what is the impact that that loan has on my life insurance policy. So how does it impact my cash value? Your cash value is the gauge that determines how much you can borrow. So your cash value, just like a line of credit, comes down when you take a loan. The death benefit is collateralized dollar for dollar. So for example, if we look at our life insurance benefit at age 50, it's about $1.8 million. What was it in the example where we never took a loan? About $2.3 million, a $500,000 difference. Now in this example, we pay the loan back fairly aggressively, which you can pay it back however you want. And you can see how much of your payment is applied to interest and also principal. But when that loan is paid back, looking at age 58 in this example, what is your cash value worth? About $1.95 million. How about your death benefit? About $3 million. What do those numbers look like when you compare them with the first illustration, where we just let the money sit and grow? Yeah, they're exactly the same. So your money continued to compound at the exact same rate as if you never touched it in the first place. This is where people use this as a tool because they know that their money will continue to compound while they can also leverage it for other opportunities. Now, when you look at policy loans, there are some bullet points that I'd like to go over. Firstly, they're very flexible. You can request it anytime you want. You can do it through your online account or even a mobile app nowadays. And whenever you request a loan, you usually get your money by direct deposit in about 2 to 3 business days. Now, payments are optional, but if you're disciplined, you can set up automatic payments, often through your online portal, or you can just log onto your online account and throw money at the balance like a line of credit. But the main point of attraction for most people when it comes to policy loans is that my money keeps compounding while I can use it. Now, if you want to take this a step further, you can look at what's called a cash value collateral loan, also referred to as a cash value line of credit. How you can take this a step further is that if you're using this for business purposes, you can capture a potential tax deduction, which is extremely powerful. Here's why. The cash value in a life insurance policy grows tax deferred, and you can access it tax-free provided we follow IRS rules, which is very easy to do. But if I have my policy that's owned in my name and I take it to a bank and I assign my cash value as collateral to the bank, they'll give me a line of credit against the cash value. But what I can do is I can get that loan under my company's name if I'm using it for business purposes. Now, all of a sudden, the interest that is billed from the bank can be tax deductible. Think about that. I've got the tax-free benefit of the cash value with my policy, but I'm also getting a tax deduction on the loan interest. That's a huge win-win. And those cash value collateral loans will often look at the loan interest rate as well, because that is important depending on where the interest rate environment is. Sometimes they make a lot of sense, other times they don't. Now, one of the biggest reasons high net worth investors use cash value life insurance has nothing to do with what happens when the market is performing well, but it has everything to do with what happens when the market is tanking. Almost everyone I know who has a decent sized investment portfolio knows that corrections are going to occur at some point. They also know not to pull money from the market during a correction. Gotta give it time and let your money recover. Now, many sophisticated investors will often use a life insurance policy as part of their overall strategy. It's a diversified piece of their portfolio. Specifically, it's meant to be a fixed income asset. Think of it as your hour-hand clock. It's going to move slow, but you know exactly where it's going to be 1 hour from now. So here's typically what I'll see someone do. So I'll give you a quick example. Let's pretend that this is you here. You're retired. You've got money in the market, and you also have money in a whole life insurance policy. The market has really been your moneymaker over time. It has gone up. However, there's been a lot of fluctuation over the years, where at times it really skyrockets, but at times you see dips occur. So I remember seeing a case study of someone who this happened to in 2008, but they had a whole life insurance policy. So what they did is they put pause on pulling money from their investment account and then started to pull money from their whole life insurance policy, giving their investment account time to recover. So it can be an excellent tool to diversify your strategy, especially if you're nearing retirement or already in retirement. Here's what I would do. I would look at your financial situation and see, what does my life look like if I just keep doing exactly what I've been doing? If it works, great, keep doing it. If you think it can be better by incorporating a whole life insurance policy, I would see what that looks like. Add that projection into your overall scenario, see where you need to get money to fund that policy, and then see the immediate impact and also the long-term impact. And this way, the numbers can speak to you as opposed to someone else giving you their opinions and telling you what not to do. Now, the last reason a lot of high income earners use life insurance is probably the least talked about, but emotionally, it's one of the most important. The permission slip to spend gives you the permission slip to actually enjoy the wealth that you've built over your entire life without worrying about leaving money to the next generation. So there's really two options. We'll call them option A and option B. Option A is the traditional approach. So let's assume that you've accumulated a nest egg of $3 million. We'll pretend that it's earning 5% per year. You've got income coming from Social Security and other sources, and the 5% annually will give you another $150,000 per year that you say, this is excellent. I am more than comfortable. I'm good for the rest of my life with this 150, in addition to other income sources that I have. Then also, when I die, this is the inheritance that I will pass to my children. So in this example, assuming a 5% return, which is producing an income of $150, you'll notice that that $3 million balance stays the same. Now, when we're taking the $150,000, we do have to account for taxes. The tax rate is going to be different depending on where tax rates are and also what your income is. I made it 24% in this particular example. After tax, the net income from this account might be $114,000 per year, but the $3 million never goes down. This is option A. So we've got the same $3 million balance, but what we're going to do here is spend this. So we're assuming the same return of 5%. I increased the tax rate because we're pulling more money here. Now, the income we're pulling in this example is $300,000 per year. Spending down the principal and interest of this investment account, when do we run out of money? Just about age 80. You pulled $300K of income. After tax, it gave you just over $215,000. That's an extra $100,000 than what option A produced. With that extra $100K, what do you think we're going to do with it? We're going to shift it over to a life insurance policy. So here, we've got $100,000 per year going into the policy. We funded it up until age 80. And what do you notice about the death benefit first? $3 million. There's your permission slip to spend, because if you pass, that life insurance benefit is now paid out income tax-free to your beneficiaries. Compared to a qualified retirement account, that gives you a whole lot more buying power, or the next generation a whole lot more buying power. Now, what if you are still kicking at age 80 and you say, hey, I still need more money? Like, what are you talking about? I'm going to be out. I still got to be able to spend. What's the cash value of the life insurance policy at age 80? $2.1 million. You can also access that cash value tax-free. Also, after the funding period, what do you notice about both the cash value and the death benefit? They're coming up. So in a case like this, you could probably very easily pull, call it $100K per year, and still see the death benefit be very, very close to $3 million. We can leverage a life insurance policy with our other assets in order to be able to spend other money more freely, without the fear of running out, and still leave the legacy that we want to. But the key takeaway here is now you can actually enjoy your retirement and still pass the amount of money that you'd like to pass. So I hope that you enjoyed this video, and I do hope that it's shed some light on life insurance in a way that you haven't seen before. If you'd like to learn more, I'd check out my next video here.